Hello and welcome back. If you are trading financial markets or intend to trade financial markets, an in-depth knowledge of financial indicators is very significant to your trading success. Some of the financial indicators that you need to know and need to follow closely are the Consumer Price Index, Producer Price Index, as well as GDP per capita figures, as well as NFPs. As a trader of Forex or stocks, have you ever wondered why exactly the market is always a buzz when there is a release of specific indicators? One of those indicators is the CPI by the US Fed. In this video, we're going to dive deep into the world of financial markets and look specifically at how CPI can either make or break your trading strategies. This is Friday Money Matters, this Friday and every other Friday on this channel. Remember that I'm offering a free tool to download. You'll find it here. And this tool is meant to help you, especially if you're venturing out for the first time or you are still new in the trading game. It is focusing on mistakes to avoid if you are trading financial markets. Please download the tool for free here. Okay, first and foremost, what is CPI and why is it important? Now, CPI stands for the Consumer Price Index, like I mentioned earlier, and this basically is a measure of the inflation rate in any given time period. You'll find out that inflation is always compared from one year to another, or from month to month, or from quarter to quarter. Usually, in most cases, if it's on year to year, they use a base year comparison where 1 year is compared to the other. So compared to a previous period, the rate can either be increasing or be decreasing. Now, all this has got significant results or consequences that it can have on any economy. But of more importance, if you are focusing on Forex trading, CPI figures will tell us basically the strength and stability of a country's currency. Therefore, whichever way it goes, it can be an indicator of how strong or how weak a currency is at any given time period. Now, the importance of it is that monitoring changes in CPI allows traders to anticipate how the market is going to behave. Therefore, if, like I said, you're trading Forex, any changes there in the CPI can help you figure out whether to actually buy a particular currency or to sell it, okay, in whatever currency pairs you are trading or you are interested in trading. Monitoring this CPI will give you a sort of insight into how the currencies are going to behave on the market, because the changes in CPI will affect the supply and the demand issues relating to that particular currency. Remember, the currency actually being paid one to another indicate the value of the currency in terms of another. Therefore, we're basically looking at pricing here. And if we're talking about pricing in any market, we're talking supply and demand, which form the basics of any price determination in any market. Therefore, the prices of currencies are also determined by the supply and demand that exist between the two currencies, therefore comparing one price to another. So therefore, we can say that a currency is appreciating relative to another, or it has depreciated relative to another. But it is also important to take note of this fact. The fact is that a CPI on its own, as inflation, is based on a basket of goods and services. In any economy, there's going to be a basket of goods and services that will be used to measure whether on a general the prices are increasing or not. Now, in this basket, in most countries, you find that there are basic commodities such as milk, bread, sugar, and things such as fuel prices and so forth. Now, on average, if this was to increase, the prices of these goods were to increase, therefore it means that inflation will increase, hence a higher CPI figure. Now, let's look at exactly what happens to any currency if CPI were either to increase or to decrease. Now, a higher CPI figure meaning that if it is higher than previous figures, basically we're saying that the inflation rate within that particular economy has increased. So in terms of increases in CPI, it means that then the central bank of that country has to do something in order to curb an increase. Now we have to understand that any economy, the CPI is a sort of controlled within a certain range. I know that in South Africa, we've got what is called an inflation target. Inflation targeting means that you want to keep it within a particular band. In South Africa, is between 3 to 6%. And then these ranges will change from one country to another depending on economic objectives of that particular country. So therefore, a higher rate is not always good. You want to make sure that you bring it back into that particular range. So if it is getting out of control, what the central bank would want to do is to use monetary policy to control it. Okay? Now, when I'm talking about monetary policy, I'm looking at the use of the supply of money as well as interest rates to control that particular inflation. Now, you remember that you want to make sure that you have stability in your currency. For the stability and the price or the value of your currency will determine how you fare as a country in terms of direct foreign investments, in terms of foreign exchange reserves and stuff like that. So in this case, we are saying that a higher rate of inflation or higher levels of CPI will cause the central bank, for example, if it's the US Fed or if the South African Reserve Bank, will cause them to increase interest rates. Now, the reason why they're increasing interest rates is because from the background, what investors are not seeing is that they want to make sure that they bring inflation by reducing demand for basic goods and services. Obviously, if interest rates are increasing, you are saying that the price of money has increased. Therefore, the demand for goods and services, especially those that are bought on credit, is going to decrease. So basically, this is what will happen. Higher rate of CPI means that interest rates will increase. Now, investors already are anticipating an increase in interest rates. So what happens? If interest rates will increase, it means that there is an increase in demand for the local currency whose interest rate has increased. Why? Because foreign investments are going to be chasing that interest rate. If they're chasing that interest rate, they want to get a return from it. So they buy that particular currency. Now, if they're buying that particular currency, it means that the demand for that currency has increased. Therefore, it appreciates in value. That's why you see immediately after CPI figures have been released, then the value of the US will either go up or will go down depending on the particular release. So if it's a higher than expected increase, therefore it will go on the upside. The dollar will shoot up in terms of value. And then this will cause other buyers to either win or to lose depending on where you were. If there is a decrease in CPI, what it basically means is that the central bank is going to reduce interest rates. Now, a reduction in interest rate is there to stimulate growth. Growth can only be stimulated if demand for goods and services are increasing. Sometimes you have seen for yourself that the release is greater than expected or lower than expected, and there is quite a big gap between what was expected and what is the actual figures. Therefore, you see these massive fluctuations in the prices of currencies that are impacted by that CPI, especially when you see the dollar trading with the euro and against any other currencies like the yen, the pound, and so forth. You find that there are huge fluctuations either on the upside or on the downside. So as a result, it creates a mayhem in the market. Either if you are trading in line with it, you are following that particular trend, you make big gains. But if you are against that particular trend, the losses are usually massive. So it is always important that if you're trading in such a market, make sure that you have very tight stop losses. Otherwise, the losses will also be quite huge. This is one of the reasons why some of the accounts are usually wiped out. So those are the main two things that happens because of volatility. Gains are usually abnormal and losses are also abnormal. Then what do you need to do? What you need to do is a couple of things. The first thing that you need to do is you need to follow news items and find out exactly what is happening in terms of the financial indicators, in this case in terms of CPI figures. Where are they on a month-to-month basis, on a quarterly basis, on a year-to-year, so that you can position yourself when such news is released. The second thing that you can do is to upskill. Go to YouTube and any other place where you can learn more about indicators. Mostly these days, some of this information comes free of charge. Go to YouTube or follow this channel so that you can get some of this information for free. The next other thing that you can do is to get a mentor who's going to teach you exactly how to use these indicators. I hope you like this video. Please leave a comment and tell us exactly which indicators you're using in your trading experience. This is results-oriented preparation. Please like, subscribe to the channel. We'll see you in the next video. Bye.